Do you have highly appreciated company stock inside your 401k? If you do, are you also thinking about taking a withdrawal, maybe to bridge the gap before pension and Social Security kicks in? Here's the problem. One withdrawal could wipe out a tax opportunity that could save you hundreds of thousands. You've contributed, you've accumulated, you've planned your exit. Taking a withdrawal from your 401k seems simple enough. But here's what many executives don't know. The moment that you take that first withdrawal, you trigger a deadline, a calendar year deadline. Miss that deadline, and a tax strategy that could have saved you hundreds of thousands disappears forever. And the problem? By the time they find out, it's too late. Taking a withdrawal without considering this clock, that's 401k critical mistake number 5. Hi, I'm David Dunn, a CPA, wealth, and tax strategist, and the founder of David Dunn Wealth. For over 30 years, I've helped technology and aerospace executives navigate the complexities of their wealth, from optimizing their 401k and RSUs to managing executive compensation and tax strategy. During that time, I've seen executives make the same costly mistakes over and over. That's why I created the Critical Mistakes series, my signature educational platform designed to help executives avoid critical mistakes, some costly, others irreversible. This is how the clock starts ticking when you take a withdrawal from your 401k that holds company stock. The moment you take that withdrawal, you'll start this clock. You'll need to distribute your entire 401k balance by December 31st of that same year, or you could permanently lose the ability to capture special tax treatment on your gains. Meet James, age 60, an executive who just retired. His 401k is worth $2 million, which includes highly appreciated company stock. James's tax situation: 37% ordinary income tax rate, 20% long-term capital gains tax rate. James takes a $100,000 withdrawal from his 401k in March to cover expenses while waiting for his pension and Social Security to start. Doing so seemed harmless. He needed the money. He's retired. It's in his account. But that withdrawal just triggered a requirement he didn't know about. And by December 31st of that year, his window to use a powerful tax strategy for these company shares will close forever. What James doesn't know, there's still a path that could have saved him hundreds of thousands in taxes, but that opportunity is closing fast. That path? It's a tax provision many executives have never heard of, called Net Unrealized Appreciation, or NUA. Here's how it works. James originally paid $200,000 to buy company stock in his 401k. That $200,000 is his cost basis. Over the years, that stock grew to $2 million, so he's got $1.8 million in gains. Here's what's still possible for James if he acts before December 31st of the same year. If James qualifies for NUA, he could pay ordinary income tax on just that $200,000 cost basis, and then pay the much lower long-term capital gains tax on the $1.8 million in gains when he sells. Let's break down the tax. Tax on the cost basis, $200,000 at 37%, that's $74,000. Tax on the gains, $1.8 million at 20%, that's $360,000. Total tax using NUA, $434,000. Compare using NUA to what many executives do. They roll their 401k to an IRA and withdraw it later, paying ordinary income tax on the entire $2 million. At 37%, that's $740,000 in taxes. The NUA savings, $306,000. But only if he avoids selling those company shares inside his 401k. Additional federal and state taxes may apply depending on your situation. That $100,000 withdrawal seemed harmless, but it came with a hidden deadline. Let's say James doesn't learn about NUA until the following year. He took that $100,000 withdrawal in March, and by the time he discovers NUA, a new year has begun. Can he still implement the NUA strategy? No. Here's why. NUA requires something called a lump sum distribution. One critical rule is that after a triggering event like retirement, you must distribute your entire 401k balance within a single calendar year. James retired. He took a partial withdrawal that same year, but he didn't distribute everything by December 31st. Now it's the following year, and he wants to implement NUA, but the IRS says no because he failed to distribute his entire balance during the same calendar year as his triggering event. Bottom line, that $100,000 withdrawal in March didn't just give him cash, it started a clock that required him to act by year end, and once that year closed, the NUA opportunity closed with it. So how does the net unrealized appreciation strategy actually work in general? It requires specific steps and precise timing. Here's what typically needs to happen. First, you need to qualify. There has to be what's called a triggering event. Second, you'll typically move everything in your 401k that's not company stock to a new IRA through a direct rollover. Third, the company stock itself gets transferred in certificate form to a taxable brokerage account, not your IRA. Fourth, these transactions must meet the IRS definition of a lump sum distribution. And fifth, you need to complete everything so your 401k balance hits zero by December 31st of the same year. Your specific situation may require different steps. That's where working with a qualified advisor becomes critical. Now, if you're thinking about taking a withdrawal from a 401k holding company stock, what actions should you consider? 3 things. First, verify you have appreciated company stock that might qualify for NUA treatment. Second, talk to a qualified advisor who understands NUA thoroughly. The NUA rules are complex, so find someone who can evaluate if this strategy fits your situation. And third, if you're thinking about taking any withdrawal from a 401k holding company stock, understand the calendar year deadline that comes with it. Because once you take that first withdrawal, the clock starts ticking. This is 401k critical mistake number 5, the third of 4 videos covering some of the most costly mistakes executives make with their 401k company stock. Each one could cost you hundreds of thousands. Be sure to watch 401k critical mistake number 3, 401k critical mistake number 4, and 401k critical mistake number 6. You've worked hard to build wealth through your 401k company stock. While the NUA strategy isn't right for everyone, if you qualify and if it fits your situation, it's one of the most powerful tax moves an executive can make. Here's how executives can avoid these costly mistakes. If you'd like to explore working together, schedule a complimentary 30-minute consultation at daviddunn.com. You can also subscribe to my complimentary email newsletter for insights from the Critical Mistakes series, and follow me on LinkedIn, YouTube, and Instagram. If this video helped clarify a complex issue, please like it, subscribe, and share it with colleagues who might benefit. Thanks for watching.